Persistent inflation is re-accelerating just as AI earnings and geopolitics are driving some of the narrowest leadership we have seen in years. You are watching vTalkInsight, Equity Pulse Daily for May 29, 2026. Let's unpack how hotter PCE, higher bond yields, and concentrated AI gains are reshaping the risk and opportunity set in global equities. The macro backdrop is being dominated again by inflation, with personal consumption expenditures running well above the Federal Reserve's target. Core PCE is tracking around 3.3% year-on-year, and short-term trends are pointing closer to 4%, marking the fastest two-month acceleration since 2021. Headline PCE is expected near 3.8%, which would be the strongest reading in roughly 3 years outside the pandemic spike, and markets are concluding that disinflation momentum has stalled. Against that backdrop, policy easing looks distant. Fed officials are openly flagging upside inflation risks and signaling they are willing to raise rates again if needed, even though markets are still only pricing in modest additional tightening through 2026. Short-dated Treasury yields have pushed higher, helped by a roughly 40 basis point jump in the 2-year TIPS breakeven, and global long-end yields remain elevated as investors digest entrenched inflation, heavier sovereign issuance, and worsening fiscal outlooks. One critical shift for equity allocators is that the traditional stock-bond hedge is not working the way it used to. With inflation risk dominating, bonds have often sold off alongside equities, breaking the historic negative correlation that underpinned many multi-asset portfolios. At the same time, central banks face limited room to cut because inflation has sat above target for nearly 5 years, government debt loads are high, and political appetite for fiscal repair is weak, all of which point to stickier term premiums. Even so, U.S. equities remain resilient, with the S&P 500 grinding higher and the VIX sliding into the mid-teens, suggesting little near-term fear. Strong first-quarter earnings and still easy financial conditions are helping equities absorb higher yields, although more investors describe bond income as increasingly attractive relative to equity valuations that may not fully reflect macro risk. The key watch point now is whether upcoming PCE prints and Fed commentary push the market narrative from a long pause toward renewed hikes, which could force a sharper repricing across risk assets. Energy and geopolitics are amplifying that inflation story. Escalating tensions between the U.S. and Iran around the Strait of Hormuz, including reported strikes and retaliatory threats, have pushed Brent crude toward the high $90 area and lifted WTI above $90. Asian equities have already traded off about 1% on the headlines, while the U.S. dollar has firmed as investors seek safety. Higher oil is feeding straight back into the inflation data. Recent PCE gains have been driven in large part by energy, and analysts expect core inflation to firm further if oil and refined products stay elevated. U.S. gasoline inventories have fallen to more than 5% below their 5-year average, reducing an important buffer for the economy just as energy costs rise into the summer driving season. For corporates, the immediate hit has been manageable, but the risk is building. So far, persistent high oil prices have not meaningfully derailed global equities, yet rising input costs in Europe are already starting to pressure margins, and analysts flag the potential for earnings downgrades into the second and third quarters if energy stays near current levels. Aluminium supply disruptions in the Gulf, which have removed roughly 4 to 5% of global output, along with government stockpiling and export restrictions in several metals, are tightening industrial commodity markets and reinforcing this margin squeeze narrative. Positioning adds another layer of fragility. Many investors remain heavily positioned for a relatively quick reopening of the Strait of Hormuz, so stalled diplomacy or further escalation could trigger a sharper risk-off move, not just in energy but across cyclicals and travel names. Conversely, even tentative diplomatic progress has been enough at times to lift U.S. equity indices and travel stocks while pulling down 10-year Treasury yields, underscoring how headline-driven and binary this energy risk has become for equity volatility. Offsetting many of these macro headwinds is a very strong earnings picture, especially in the U.S. S&P 500 companies delivered a roughly $10 per share earnings beat in the first quarter, with about two-thirds of firms topping estimates and expanding margins. That surprise alone mathematically explains a large part of the recent index rally and helps justify valuations in the low 20s on forward earnings, even as growth data soften at the margin. The growth engine behind those earnings is heavily concentrated in technology and AI infrastructure. Major hyperscalers are in the midst of a roughly $700 billion capital expenditure cycle, with close to a quarter of new bond issuance tied to data centers and related projects. Recent analysis suggests that semiconductors, hardware, and software together accounted for as much as 95% of U.S. GDP growth in the first quarter, highlighting just how dependent the macro picture has become on tech. Company results this week underline that story. Snowflake reported revenue growth above 30%, raised its outlook, and announced a $6 billion five-year cloud partnership with Amazon Web Services, sending the stock up almost 40% in pre-market trading and helping shift the narrative from AI disruption toward AI-enabled software acceleration. Dell sharply upgraded its fiscal 2027 AI server revenue target from $50 to $60 billion, with its infrastructure solutions revenue nearly tripling year-on-year and margins holding up thanks to tight supply chain execution. Both signals point to a durable, hardware-heavy AI build-out that extends well beyond the mega-cap chipmakers. Yet the AI trade is becoming far more selective and arguably more fragile. Software names that can clearly monetize AI, such as Snowflake and Datadog, have been rewarded, while Salesforce and MongoDB saw their shares fall sharply despite headline beats because guidance and AI traction underwhelmed elevated expectations. Okta's improving retention metrics and identity security show that some specialized platforms are gaining from the rise of AI agents, but overall market leadership remains extremely narrow, with a handful of AI and semiconductor names driving a disproportionate share of index-level growth. Several participants now flag the risk of a 10 to 20% consolidation in AI-exposed stocks after extreme gains, even if the longer-term capital expenditure and productivity tailwinds remain intact. Turning to the real economy, the consumer picture is more nuanced than equity indices suggest. Recent revisions shaved first-quarter U.S. GDP growth from 2% to 1.7%, with consumption also revised lower, and real consumer spending growth has slowed to around 0.2% as inflation erodes nominal gains. Real disposable income is contracting and the savings rate has dropped toward 2.6%, yet household net worth has surged to roughly $75 trillion, with stock ownership now exceeding real estate for the first time since the 1990s, supporting a powerful wealth effect. In retail earnings, that tension shows up as extreme dispersion. Value-focused chains like Best Buy, Kohl's, and Dollar Tree have delivered results ahead of very low expectations, sparking double-digit share gains in some cases. Dollar Tree, in particular, rallied after better-than-expected numbers and operational progress following its Family Dollar separation, with strong store traffic indicating that demand for value remains robust even as inflation bites into lower-income budgets. At the same time, consumers are shifting spend toward essentials such as fuel and groceries, boosting discounters while pressuring department stores and discretionary categories. By contrast, mid-tier apparel and housing are clearly feeling the strain. Gap cut its annual sales growth outlook from 3 to 2% after weakness at Old Navy and Banana Republic, sending its shares down sharply, while American Eagle Outfitters sold off more than 10% despite beating earnings as investors questioned inventory management and the durability of its turnaround. New home sales dropped over 6% month-on-month, reflecting the combined drag from higher mortgage rates and sticky inflation on rate-sensitive sectors. Altogether, these signals point to a consumer that is still spending, but with growth increasingly reliant on asset-driven wealth at the top and value hunting at the lower end. Under the surface, the structure of credit and equity demand is also evolving in ways that matter for stocks. Credit spreads have tightened back near levels last seen in 2007, despite elevated inflation and geopolitical risk, helped by strong demand for clean credit stories and limited new supply outside AI-related projects. High-yield markets in particular are seeing enthusiastic appetite for AI and data center financing, while sectors more exposed to inflation or software-specific risks are trading with a discount. At the same time, the boom in private credit, especially in Europe, is drawing more scrutiny. Looser regulation than for banks, limited transparency, and concentration in sectors like software have raised concerns about potential systemic risks if growth slows or underwriting standards slip. Yet global M&A remains robust, with deal volumes on track toward $4 trillion as private equity exits rebound and larger sponsors continue to access capital, suggesting that overall liquidity in corporate finance is still ample. Equity market structure is shifting as well. Index providers are preparing to fast-track mega-cap IPOs such as SpaceX into major benchmarks, potentially within weeks of listing and even before profitability, which could force active managers to rebalance more quickly, but is expected to be largely offset by over $1 trillion of projected corporate buybacks. On a longer horizon, a new public-private initiative that funds indexed investment accounts for U.S.-born children already has interest from more than 5 million prospective accounts, pointing to a gradual broadening of the retail investor base and a deeper pool of passive equity demand over time. These structural forces may not drive day-to-day price action, but they will influence how shocks from AI, rates, or geopolitics are transmitted through the equity ecosystem. Stepping back, the equity story right now is a tug-of-war between re-accelerating inflation and an extraordinarily powerful AI-driven earnings and capex cycle. Higher for longer yields, energy shocks, and a fatigued consumer argue for more volatility and a greater role for macro and equity pricing, while strong corporate profits, narrow but explosive tech leadership, and ongoing fiscal and structural demand for equities continue to support index levels. The balance of risk increasingly hinges on a few key variables: the next leg of PCE inflation, the trajectory of oil and refined products, the durability of AI monetization beyond early leaders like Snowflake and Dell, and how stretched credit and equity valuations respond to even modest disappointments. For equity watchers, the signals to monitor are clear. Whether earnings leadership broadens beyond mega-cap AI, how quickly consumer and housing data cool from here, and any sign that private credit or liquidity conditions start to crack. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.